Hello, this is Alan Henry with HenrySellsHouses.com. What we're going to talk about now is traditional sales. Most people believe that the only way to sell a property is to have an agent listed on the multiple listing service, otherwise known as the MLS, stick a sign out front, conduct tours for potential buyers, and receive cash from the sale or from the buyer directly or the buyer's lender. Most self-proclaimed real estate professionals will tell you this is how it goes, but unfortunately, this is far from the truth and often leads to stressed out buyers and sellers, delayed closing, delayed transactions, transaction failures, or any other sort of horrendous behavior during negotiations. Trust us when I say this is the norm. It's not the exception. When transacting real estate using traditional methods, these types of scenarios come across more often than not. In these situations, the adversarial relationship is created between the buyer and the seller. Agents and brokers can help to keep the distance between the two parties, but this is when things begin and start to slide right off the rails. Communication is paramount in negotiating and in any sort of messages. If messages are not properly communicated, they get distorted, and the further from the source they travel, the worse often it becomes. The worse it will become. Most of the time when we see sellers and buyers digging in their heels and playing hardball, it's due to poor communication and competing interests of the agents and their clients. Agents want to help their clients get the best possible deal, but they also want to close the deal fast and not waste any time at all. Collaboration can be out of reach when selling your property under these types of situations. The second problem with traditional methods is that the outcome of the sale can often leave the seller in a bad financial position. Now, why would the seller, the person hopefully receiving a lump sum of cash, be the one in a bad financial position? It's because stuff like Uncle Sam will require a large amount of cash in the form of a capital gains tax. The rest of the cash comes at an opportunity cost, since the cash could be earning an interest return in another investment. Far too many sellers end up sticking their proceeds into the bank or at best some low yielding investment vehicle. Cash has a funny way of burning holes in pockets also. From sellers, cash in hand gives a sense of security. Maybe it will be used for retirement or for a trip, but either way the cash needs to be put to work earning interest. How much of the sales proceeds will go towards taxes? There's a formula that I'd like to go through here. Because as a seller, understanding your tax burden starts with determining how much your profit will be from the sale. Well, this may seem like an easy answer. It's not usually so simple. The formula here shows the easiest and most accurate method that you can use to compute your profit. But ask your accountant about it. So what you have is sales price minus concessions, things like commissions and closing costs, and then also minus the or subtract your basis, and that will give you your profit. The basis is calculated by adding the original purchase price of the property to the amount of the capital improvements made to the property, less depreciation that was deducted on your tax returns. Okay, so for example, if you sell a property for $400,000 and you agreed to $6,000 worth of concessions for a broker, $6,000 worth of concessions for a item such as a broken sewer line, plus a 6% realtor fee, this would total $24,000. That makes your closing costs were $4,000, your adjusted sales price would be $370,000. You would then subtract your basis from the adjusted sales price. Okay, so let's continue the example a little bit. Say you purchased the property 15 years ago for $90,000, and over the years you put $40,000 into a new roof, new HVAC, kitchen upgrade, etc. You also made depreciation deductions totaling $38,000. Your basis then would be $92,000. Your profit is calculated by subtracting your basis from the adjusted sales price. So $370,000 minus $92,000 equals $278,000 of profit. Yeah. So since you have been a long-time owner of the property more than 1 year in the eyes of the IRS, your capital gains rate is between 15 to 30% for combined state and federal capital gains. It's unlike short-term capital gains, which are taxed at a regular income, and it would thus be subject to a tax bracket in which you currently fall within for that particular year. On a $240,000 of profit and 25% capital gains tax, you would write the IRS a whopping big fat check for nearly $70,000. Just gone. Poof. Ouch. Okay, right? Ouch, right? The taxes are more than most people make in a year. There is a reason that April 15 sticks out in the minds of Americans, especially for property sellers with large profits. Rarely do they ever forget the day they had to write a large check to the IRS for capital gains. Things to remember here. The traditional method of selling property creates a win-lose scenario between buyers and sellers. Second point, cash sitting in a bank account can hurt you due to inflation. Third, money needs to be working for you so that you do not have to live off the savings account. And any profit made when selling investment property will be taxed by the government. Now in the next section we'll talk about any government allowances you may get from the IRS, or tax advantage or tax benefits or anything like that. So just hold those questions till the next time we meet. And for now, this is basically how a traditional sale goes off and the things that you should be thinking about. My name is Alan Henry with Henry Sells Houses. For more information, please contact me. Thanks.